Imagine this. You've spent years building your savings. Maybe you sold a vehicle. Maybe you inherited money from a relative. Maybe you've simply kept cash at home because that's how you've always managed your finances. One day, you walk into your bank carrying more than $10,000 in cash. And suddenly, you remember something you've heard before. Don't deposit more than $10,000. Split it up. Use different days. Keep it under the limit. Millions of people believe some version of this advice. The problem is that much of it is completely wrong, and following that advice could create a far bigger issue than the one you're trying to avoid. Today we're going to talk about one of the most misunderstood financial rules in America. We'll discuss what really happens when you deposit a large amount of cash, why banks file reports, what behavior raises concerns, and how ordinary people accidentally create problems for themselves by acting on bad information. Most importantly, I'll show you how to handle large deposits correctly so you can avoid unnecessary stress and keep your financial life simple. Let's begin. Ask 10 people what happens when you deposit more than $10,000 into a bank account. You'll probably get 10 different answers. Some believe the IRS is automatically notified. Others think the government starts watching their accounts. Some assume they'll be audited. And many people believe the safest option is simply to break the money into smaller deposits. That last belief is where the trouble usually begins, because the truth is far less dramatic. Banks process millions of transactions every day. Large deposits happen constantly. Business owners make them. Families make them. Retirees make them. People selling cars, boats, equipment, and property make them. Most of these transactions are completely ordinary. The banking system was designed to recognize that reality. But it was also designed to identify patterns that could indicate criminal activity. And that's where misunderstandings start. To understand the rule, you first need to understand why it exists. Governments around the world try to combat money laundering, organized crime, tax evasion, and other financial crimes. One of the ways they do this is by requiring financial institutions to report certain types of transactions. The goal isn't to punish honest people. The goal is to identify suspicious financial behavior. That's an important distinction. A report is not an accusation. A report is information. Think of it like a security camera. The camera records what happens. It doesn't automatically mean anyone did anything wrong. Unfortunately, many people hear about reporting requirements and immediately assume they're in danger. In reality, the vast majority of reported transactions never lead to any further action. For most law-abiding citizens, life continues exactly as normal. Now let's talk about the mistake that catches people off guard. Imagine you have $15,000 in cash. You plan to deposit it. Then someone tells you that deposits over $10,000 are reported. You start thinking, what if I deposit $7,500 today and the rest next week? At first glance, that sounds harmless. In fact, many people believe they're being cautious. But banks don't only look at individual transactions. They also look at patterns. If someone repeatedly deposits amounts just below reporting thresholds, that behavior can appear unusual. The system doesn't know what's happening inside your head. It only sees activity, and activity creates patterns. The irony is that many people who try to avoid attention end up attracting more attention. Not because they're criminals, but because their behavior resembles patterns that financial institutions are trained to monitor. This is why financial professionals often repeat the same advice. If your money is legitimate, don't try to make a normal transaction look unusual. Let's say you sell your pickup truck for $18,000. The buyer pays in cash. Everything is documented. You have a bill of sale. You have messages between you and the buyer. You have proof of ownership. In other words, everything is legitimate. Now imagine two different people handling this situation. The first person deposits all $18,000 at once. They keep their paperwork. If anyone ever asks where the money came from, the answer is simple. The second person deposits $4,000 one week, another $5,000 the next week, then $4,500, then another $4,500. From the outside, which situation looks cleaner? Which one creates a clear financial record? The answer is obvious. Sometimes the simplest approach is also the smartest one. Most people spend far too much time worrying about transaction amounts and not enough time thinking about documentation. Documentation is what tells the story of your money. Without documentation, A pile of cash is just a pile of cash. With documentation, it becomes understandable. A vehicle sale, an inheritance, a gift, a property transaction, a business payment, a transfer between accounts. Good records create clarity, and clarity removes uncertainty. Whenever a significant amount of money changes hands, create a paper trail. Save agreements, save receipts, save contracts, save confirmations. Store them somewhere safe. 5 minutes of organization today can save weeks of stress years later. Let's consider another situation. A relative passes away. Months later, the estate is settled. You receive money from the inheritance. This is an emotional period. People are grieving. They're handling legal matters. They're making financial decisions while dealing with loss. The last thing anyone wants is confusion regarding the money they've received. This is why organization matters. Keep copies of estate documents. Keep communications from executors. Keep records showing how the money was distributed. The goal isn't paranoia. The goal is preparation. If questions ever arise in the future, you'll have answers immediately available. Family gifts create another source of confusion. Parents help children buy homes. Children help aging parents. Grandparents assist grandchildren with education. These situations happen every day. Yet financial myths continue to spread. Someone's neighbor says one thing. A friend says another. Social media says something else entirely. Soon, nobody knows what's true. The reality is that gifts and transfers often have specific rules and requirements depending on circumstances. That's why relying on random advice can be dangerous. When significant amounts of money are involved, facts matter more than opinions, and records matter more than rumors. What's fascinating about this topic isn't the banking system. It's human psychology. People fear being watched. People fear making mistakes. People fear government agencies. As a result, they sometimes make decisions based on emotion rather than logic. Fear creates overreactions. Overreactions create unnecessary complexity. Complexity creates mistakes. The people who avoid problems are usually not the ones who know every regulation by heart. They're the ones who stay calm. They keep records. They follow normal procedures. And they don't let fear drive financial decisions. Imagine you're looking at thousands of transactions every hour. That's essentially what banking systems do. They're not focused on a single customer. They're looking for unusual activity among millions of customers. This is important because many people assume the bank is specifically watching them. In reality, banks rely heavily on automated systems. The software identifies patterns. The software identifies anomalies. The software identifies behaviors that differ from normal activity. This is why consistency matters. The clearer your financial behavior is, the easier it is for systems and institutions to understand what's happening. One of the most expensive things in personal finance is bad advice. Not scams, not fraud. Bad advice. Because bad advice often comes from people who genuinely believe they're helping. Maybe they heard something years ago. Maybe they misunderstood a news article. Maybe they repeated something they heard from a friend. But misinformation spreads quickly, especially when money is involved. Before acting on financial advice, ask a simple question. What is the source? If the answer is a neighbor, a cousin, or a random comment online, you may want to verify the information before making important decisions. Here's a habit that can benefit almost everyone. Create a transaction folder. Physical, digital, or both. Every time you receive or move a significant amount of money, save 4 things. A description, supporting documents, proof of deposit, proof of transfer. That's it. Nothing complicated. No expensive software. No complicated accounting systems. Just organized records. Over time, this creates a financial history that explains itself. And that's incredibly valuable. One lesson appears repeatedly in personal finance. The people who experience the fewest problems often follow the same principle. Keep things simple. Simple transactions. Simple records. Simple explanations. Simple documentation. Complexity rarely protects you. More often, complexity creates confusion. When money has a legitimate source, simplicity is your friend. The biggest misunderstanding surrounding large bank deposits is the belief that the report itself is the problem. For most honest people, it isn't. The real problems often begin when people act on fear, rumors, and misinformation. They start changing normal behavior. They start creating unusual patterns. They start making simple situations unnecessarily complicated. Instead, focus on what actually matters. Know where your money came from. Keep good records. Maintain documentation. And handle legitimate transactions in a straightforward manner. Because at the end of the day, financial confidence doesn't come from hiding what you're doing. It comes from being able to explain it clearly. If you found this video helpful, let me know in the comments. Have you ever made a large deposit and worried about what might happen? I'd love to hear your experience. And if you'd like more videos covering personal finance, retirement planning, banking rules, and money mistakes that people commonly make, be sure to subscribe. Thanks for watching, and I'll see you in the next video.